Hi, I'm Jimmy. In this video, we're looking at Leggett Platt, ticker symbol LEG. This video is part of our Dividend Aristocrat series, where we're analyzing each of the company within the Dividend Aristocrats ETF, with the goal of seeing if we can identify the top Dividend Aristocrat stocks that ultimately have a good chance of paying us reliable dividend over the next few years and get us closer to our goal of financial freedom. Okay, so first I'm going to dive into Leggett Platt's business, and then we'll see if we can come up with a fair value of LEG stock using both the dividend discount model and a discounted free cash flow model. Okay, so let's dive into Leggett Platt's business first. This is their business broken out by their revenue in 2018 according to their segments. Okay, simple enough. They seem fairly well diversified, but let's look a bit closer at each segment to see what we can find out about them. So the largest segment is residential products. What they do is they supply the machines and the parts used by bedding manufacturers so that the bedding manufacturers can produce the products that they create and ultimately sell to the public. We can see that this segment's revenue history has been somewhat stagnant over the past 10 years. Now, this is a little bit deceiving at first glance because in 2016, the home furniture part of this business segment, well, the management reassigned that going into, leaving 2016, going into 2017, they reassigned that to the second largest segment, which is furniture products. That becomes much more obvious when we look at the furniture products revenue chart, and clearly the switch in segments is much easier to see in a segment that had smaller revenue. Now, one of the reasons I like to look at the business's segments in general is that I like to look at the history of revenue if the company provides it, and hopefully we can come across where the opportunities or perhaps where the threats are to the business. By looking at this type of thing, we can identify where the growth is or where the weakness is, and then see what we can forecast from that particular business line. I only came across this particular segment change because when I looked at these numbers, well, this change in this particular chart really jumped out at me. That's really unusual. Something must have happened here. It could have been an acquisition, or maybe Leggett Platt got a big new customer, or something along those lines. In this case, it was really just a shift internally, but that's good information to have. Now, if you're curious, once I saw this big jump in revenue, I went straight back to the 2017 annual report for Leggett Platt, and I wanted to see what management was saying about this. They almost certainly had to address what was happening here. Now, I only bring this out because I'm hoping, whenever I'm doing my research, I'm hoping to try to remain aware of potential red flags or strange things happening, like an enormous jump in revenue or enormous decrease in revenue. So if we ever see a huge drop or a huge jump in revenue, I don't think we should just accept that. Let's look and try to understand why it's happening. Now, this is important because this jump here, although they didn't jump as much as this chart appears, they did have internal growth of about 6%. So it's good to know that they are in fact growing. And I actually think that this division and the division before, well, they're both two of the brighter points for Leggett Platt going forward. A lot of analysts are expecting for 2020 to be a solid year for them. So that's a good thing from an overall growth perspective. Okay, next up we have the specialized product segment. And as we can see, this is a real growth point. It has been for the past few years. Now, this division, what they do is they supply a whole ton of products to the automotive industry. They make seat suspensions, lumbar support systems. They make parts for the aerospace and the construction industry. They do a lot of different things, mostly around seating, but overall we can see that their growth is looking quite good. Then we shift to their smallest segment. This is the industrial products segment. And here we can see that overall they've been struggling. And what they do is they produce steel rods and drawn steel wires. And this industry has struggled. There's been deflation in the steel market, and that's become a problem for them in a very commodity type of business, a business where they're competing mostly on price. So this is not a very high margin business line for them. So overall, when we switch over to their overall revenue, we can see that they've done a decent job. And I actually expect for them to do fairly well in the next couple of years, since some of their higher end products seem to be doing better compared to the steel business that they're in. Okay, now let's see if we can come up with a fair value for LEG stock. So the first valuation method is called the dividend discount model. Now I've got a link in the description below on how to do this exact formula. It's a fairly simple calculation. But for the sake of this video, Basically, with our required rate of return, which I'm using 8.5%, that would imply that the fair value of Leggett & Platt stock is about $45 per share. Right now, LEG is trading about $50 or $51 per share. So with this valuation method, it seems that LEG's stock seems a bit overpriced. But what about when we switch to the discounted free cash flow valuation method? Once again, I got a link in the description below walking us through how to do this whole thing. In fact, I created an Excel template. If you're interested, you can find a link in the description below, walk you through how to do this whole thing. But to summarize for this video, well, I found these analyst estimates, and there are the free cash flow analyst estimates going out the next few years. Then I used a required rate of return of 8.5%. That's the same required rate of return I used in the last valuation method, the dividend discount model. Then I used a perpetual growth rate of 2.5%. That is how much we expect for their free cash flow to grow forever, in perpetuity. This gives us a fair value of the company. Then we divide that by the shares outstanding, and that gives us a total fair value of about $52 per share. Now, this fair value estimate is about $1 higher than the current stock price. So overall, it seems that Leggett & Platt's stock is about in line with our calculation of fair value. Slightly above it here. Oh, the current stock price is slightly below this one, slightly above the dividend discount model. So although I like this business, I do want to see the stock pull back before we get involved in it. Now, in this whole series, we're going through all the companies in the Dividend Aristocrats ETF. So we expect these companies to have good dividends, good dividend history, and ideally, we expect them all to be covered, a lot like Leggett & Platt's dividend history. We expect the profits to cover the dividends that they're paying out. Now, we actually did a similar series on this channel where we analyzed all the companies in the Dow Jones Industrial Average. And then we created 3 different portfolios: a value, a growth, and a dividend portfolio, using nothing but the companies that we analyzed on this channel. Now, I think it makes sense to see if we could take 5 or 10 companies from the entire Dividend Aristocrats ETF and see if we can add those companies to our dividend portfolio and try to see if we can evolve that portfolio to be even stronger. If you're curious to see what our dividend portfolio looked like from our Dow 30 analysis, that could be a good next video for you to watch. There's a link here and there's a link in the description below. And thank you so much for sticking with me all the way into the video. I really do appreciate it. I'll see you in the next video.